Is the second iteration of the dot-com bubble about to burst? I'm Yasmin Khan with The Breakdown, and I don't know how old any of you are who are watching this right now, but do you guys remember the first time this happened back in the late 90s and the early 2000s? I was in junior high school, and people seriously thought that the world was going to end as soon as all the clocks struck midnight into the new millennium. They thought this because all of our records that were being managed by computers were going to go from 99 as in 1999 to 00 as in 2000, but maybe as in 1900. Was everything going to go back to whatever it was in the year 1900 before any of us had ever been born, to a time before digital record keeping was even a thing, to a time before electronically managed automation systems? We went into the new millennium holding our breaths, partly expecting the technologically dependent world and society that we had built to collapse before our eyes. We all held our breaths, and then we let out a collective sigh of relief when nothing happened. The world carried on as it had always done. But that didn't mean that we were immune from the economic bubble we had recklessly inflated throughout most of the 90s, the bubble that was just months away from bursting. The internet had come onto the scene in the 90s, eventually making its way into households and classrooms and quickly changing the way people thought about everything: entertainment, education, business, the economy, globalization, government, etc. It was young, it was malleable and vulnerable, and we didn't fully understand what it was or what it was capable of. A lot of effort was put into growing this thing, however that happened. But the goal wasn't necessarily to provide a product or service to people or even to grow profits. It was to capture market share. It was to get in on the ground level, to be a part of the growth, to earn some influence, and to build a legacy on a platform that would come to define the foreseeable future. And it all started with a company called Netscape. It was a web browser that anyone could have access to for free. It wasn't necessarily profitable, but it was popular and it was innovative. So when the company went public, its share price shot up from $28 to $75 on its first day of trading. And this triggered open season on internet investments. With a hospitable economy, investors sought more young internet companies to put their money into. Problem was, a lot of these companies were going public before making any money, but they figured if Netscape could do it, we could probably do it too. Instead of bringing money in, they were spending money on ads, again in an effort to just get in front of people. Investor overconfidence kept pushing stock prices for these unprofitable companies higher and higher, which would trigger more confidence, which would inspire more investors to get in, which would push stock prices for these unprofitable companies higher and higher. Until the Fed raised its interest rates, making it more expensive and more risky for people to invest. Until Japan, a major player in the tech world, went into recession. Now, these factors and others triggered a massive sell-off. People were getting out as quickly as they had bought in, and stock values, including Netscape's, declined by as much as 75%. Suddenly, these companies had super high million-dollar valuations, but no way to keep up with everything that valuation entailed. If you guys have ever seen Silicon Valley, you might remember this. It was a whole plot point. But the thing with the stock market is that we know it's not necessarily reflective of the economy. And the thing with money is that revenue is not the same as profit. If a company is spending more than it's bringing in, it's not profitable. In the 2000s, these internet companies were spending all of their money on ads without bringing in enough revenue to justify their valuations. Today, we're seeing something similar. Large tech companies, while they may still be profitable, are losing value. Part of the reason for this is their own projections. Amazon lost 20% of its value in a single day last October because it brought in just 0.4% less than they projected they would. It was presumably taken as a bad sign of the times and a negative indication of what kind of trajectory the tech industry is on. Also, Meta is projecting that they'll bring in less money next year and they'll be spending more. In other words, they're projecting that they will be less profitable next year than they were this past year. Not great for investor confidence. Meta has already lost $800 billion in stock market value since September of last year, and the lack of enthusiasm over the metaverse can't be helping. And a loss that big, that's a 75% collapse, a figure reminiscent of the 2000 burst. Another consideration is that the dollar is strong now, meaning companies that do a lot of business overseas, like Amazon, could actually lose money once they convert weaker foreign currencies back to the stronger dollar. And of course, you have to factor in all of the other economic considerations from the pandemic and the post-pandemic eras. We're already seeing massive layoffs and hiring freezes from tech companies, and we're seeing everything that we're seeing go on with Twitter. Elon is losing investors and advertisers rapidly, but I think it can be safely said that his particular nightmare is largely of his own making. Regardless, confidence in the company's future is down. The 2000 burst was slow moving but predictable, at least in retrospect, as so many things are. So much of life is just people and systems falling into patterns of behavior, and while you have to consider unique circumstances as they present themselves, that doesn't mean that lessons of the past are irrelevant to the lives we live today. All right, that's it for me. Please like and subscribe if you got something out of this, and be sure to follow me on Instagram and TikTok. Thank you.